All right now we are going to cross to a conversation that is already in progress. Bloomberg's Eric Schatzker is speaking with Bridgewater Associates' Ray Dalio as part of Bloomberg's Bloomberg Invest Talk series.
In the way of fiscal stimulus from the federal government and monetary stimulus from the Federal Reserve appropriate? Are both of those organs of the U.S. government, if you will, doing what they should be doing? And if they're not doing quite enough yet, what else should they be doing?
Yes, in my reaction, there's no choice. It's like in the 2008 financial crisis, you're faced with a choice. Do you want those banks to exist in the future, or do you want to get rid of those banks? And they may have gone broke, and they may not have had enough savings, and they may have done even things that they should bear the consequences of. But you want to save the banks. And so this is a crisis that's similar, except it goes way beyond the banks. So when you start to think, who do you want to save, you have to think about, do you provide them with income, and how much do you deal with their balance sheet? And if you don't do that, the consequences are enormous. So the reaction needed to be of the sort. We have to think about the consequences, though, of producing all that money in credit. Where does it come from, and what does it mean? We'll turn to that in a minute. But it's just like in the Great Depression. You needed to do that, and you will need to do more. And we will argue over what we should do and who gets what. And that'll be our big discussion. But yes, there has to be more money in credit, and you have to operate in a way where you save important things, and that you only impose a certain amount of suffering on people that they can bear. Otherwise, you'll have a revolution, and you won't have productivity.
Ray, can we talk about some of those consequences? I think that's a critical part of this conversation. When you say the word consequences, are you thinking about economic consequences like inflation, for example, a product perhaps of all the liquidity that's being generated by the government? Are you thinking about the impact that it has on the treasury bond market? Are you thinking about the impact that it has maybe on the foreign exchange market? Are you thinking about those things? Or are you thinking more broadly? Tell me.
Of course, it's my responsibility to think about all of those things. And that's my passion since I was a kid. I'm thinking about all those things. And then you also have to bring in the elements of wealth gaps and politics. The world does not operate just without consideration to how wealth is distributed. So I'm thinking, for example, that when we look ahead, the world is going to be very different. Like when we think about how you'll pay for it. Will there be a reversal of the corporate tax cut, for example? The paradigm that we were in since about 2008 until it ended with the downturn was one in which just mechanistically certain things happened that supported markets, and they included things that probably are not repeatable. For example, when you had a corporate tax cut, the decline in corporate tax rates benefited stocks. When you had interest rates go down, the effect of lowering that interest rate caused all asset prices to rise because they all compete. And so that causes a price earnings expansion. But we won't have in the future interest rates go down in the same way. You had expansion in profits and wealth assets prices going up for the purchase of those, and that benefited those with assets more than those without assets, and that created a wider wealth gap. So you had low levels of interest rates caused corporations to borrow and to buy back stocks and to buy other corporations because the returns on equities were greater than the cost of funding. And that supported prices. And that created a certain cash flow. You're not going to have that. So as we come into the new paradigm, we have to realize that even, how is capitalism? How will it mechanically work? What does it mean for redistributions of wealth? All of those questions are part of the same series of questions you asked. So when I think about foreign exchange, when I think about each of the markets, I have to look at it in that holistic way to figure that out. And then I think about that globally. You just can't think about it as one thing. The United States' conditions are different from Europe's, and a difference from China, and different from other countries. And those differences are important. So I have to think about all that, yes.
Now, I was just going to say, could you give us a sense, so you've established some really valuable context, but I want to try and get a better sense of how you think it's going to play out. So things are not going to be the same. What is going to happen with inflation? In the period after the financial crisis, we saw this monetary levitation. We saw asset prices rise. As you pointed out, we saw a widening of the wealth gap, if you will, the rich getting richer. We did see the buybacks that you talked about, the amount of leverage that was built into the corporate economy. How will that be different? Are we going to have more inflation? Will asset prices rise the way they did before? Is, to the point that you just made a moment ago, will the Fed in its asset purchase program be able to manage interest rates and yields, more importantly, market yields, the way that it's been able to up until recently?
Well, you gave me a bunch of questions there, so I'll take them bit by bit. Let's start with the inflation component. There's inflation in goods and services, and then there's the value of money and inflation in certain assets. I think the period that we're going through right now is most analogous to the 1930 to 1945 period in many, many, many ways. And so in that period, what you had is deflationary pressures, much the same way as we have deflationary. I mean, think about is the supply demand of goods and services such that it's tight? And in other words, we're short of the goods and services, and so prices are high. And that's one type of supply-demand inflation. Then there's monetary inflation. And so like in the 1930s period, when you had deflation of goods and services, and you had inflation because of financial assets and other things because they produced it. And so you saw a series of currency declines. So you saw one country after another devalue its currency in relationship to other countries' currencies and in relationship to gold, which was then considered the money. And so there were those devaluations. Very similar. Another period of time that seems very similar to me is the 1980 to 1990 period, because what happened then is the world had a lot of debt and money was tight. And then what happened is there was a debt crisis, and it differentiated some countries from other countries. So the emerging countries that owed a lot of debt and also didn't have the best benefit of the money that was coming out of the Federal Reserve had a crisis from 1980 to 1991 when they put the Brady bonds in. But at the same time, the United States was going through a reflation period in which assets reflated, but inflation rates fell globally. So it's important to distinguish what we mean by inflation. This is not a supply-demand kind of global supply-demand. We're going to be short of things, we're going to bid up its price kind of inflation. We have to deal with the monetary inflation. And I think in the early stages of this, you're going to see it reflected in asset prices. So you see it reflected to some extent in gold and to some extent into stocks and other things. I can get into what I think will be the sort of the beneficiaries of that. It'll be a different kind of world. It'll be difficult to, it'll be a very selective world as to what will do well. But pay attention to the value of money. What is a storehold of wealth? No, don't just look at goods and services, because I think when we look at an economy the way we normally do, We just think it's all a function of goods, services, stocks and bonds and so on. And we may not pay enough attention to the value of money. I think we'll be in an environment where that'll be a very important issue.
Ray, I'm just going to take this opportunity to ask the second polling question of our audience. Let's bring it up, and here it is. What quarter will the U.S. economy return to positive growth? Will it be the third quarter of 2020, the fourth quarter of 2020, sometime in 2021, or once again later than anybody thinks? I'm going to give the audience time to think about that for a moment and to register their responses. Ray, I'm going to take this opportunity as well to weave in a question from our live audience. I can't tell you where it's coming from, but it seems relevant given what you were just saying. Is it surprising for you, Ray, to see global equity markets enter what amounts to a new bull market while we're still in the middle of one of the worst health, economic, and financial crises in modern history?
No, not at all. I mean, just like you can go back to the dates of announced reflations. You have a hole. The economy follows. This is the important thing. Even when you're asking the question of others, when will it fill in? You have to understand the financial part of it, what it means from incomes and balance sheets. And so what I'm saying is, let me give, I can give you the dates. So it was the date that the bottom, when the Federal Reserve and the Treasury in 2008 announced its program to produce enough money and credit to buy financial assets that we entered the new paradigm. It was the date that Mario Draghi...
I'm going to interrupt you for just a moment. I'm interrupting you, Ray, just to make one point that I think people are trying to wrestle with right now as they listen to your answers. You're absolutely right that the Fed and the government, for that matter, at least in this country and then elsewhere in Europe, took action in 2008, and clearly the federal government took action and the Fed took action back during the Great Depression. But there's often a lag between the moment they fire the bazooka and the moment that we, so to speak, hit bottom. The bazooka has been fired a number of times over the past few weeks. We don't know whether we've seen the bottom, whether it's the economic bottom, probably not yet, or the financial market bottom. How do you think about that?
I think you're not adequately distinguishing economic activity and stock prices and financial market considerations. I learned this early in life. It was so funny when I was a kid. I was, invested as a kid, and I would see the economy get stronger and stronger and stronger, and I would see the markets go down, down, down. And then I would see the economy get weaker and weaker and weaker, and then I would see them go up, 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 based on what the amount of money and credit is. So it goes, when it gets stronger and stronger, and let's say money becomes tighter and tighter, and central banks become tighter and tighter, that has an effect on the present value of all cash flows.
Speaking, of course, with Ray Dalio of Bridgewater Associates, and I just want to point out that you can continue to watch the rest of this interview on your Bloomberg. Just use the function Live Go.
And then we have to say, where does the money and credit flow? And you have to follow those flows.